Okay, it's Wednesday, January 21st, 2026. The report is in from Hong Kong, and frankly, if you're looking at your portfolio this morning, you might be feeling some serious whiplash.
Whiplash is a good word for it. I think bipolar might be the exact right word for this environment.
It's just a chaotic start to the day. On one side, you have a historic, just a record-smashing rally, and on the other, a massive liquidation event that's causing, well, absolute carnage.
It's the definition of mixed signals.
So today, on this deep dive, we're going to parse the vivimoneyDaily report. We're trying to figure out exactly why all this capital is splitting so violently.
It's a fascinating setup. If you look at the report we're using today, the theme is, well, it's undeniable, the great divergence.
It's a great divergence.
You've got money just fleeing into defense. That's your precious metals. And then you have money trying to hide out in offense. And that's pretty much just AI.
And everything in the middle.
It's getting squeezed hard.
That middle ground really does seem like a dangerous place to be right now. So let's set the scene a bit before we dive into the actual tickers. The fear gauge, the VIX, it's flashing, isn't it?
It is. Yeah, the volatility index, it touched 20 this morning. Now, for anyone listening who doesn't watch the VIX every single day, 20 is a big psychological line.
Right. It's a tripwire for the algorithms.
Exactly. Below 20, things feel, relatively calm. But once you're above 20, the cost of safety, buying put options to protect your portfolio, it gets expensive fast.
So it tells us the risk premium is going up.
The market is officially nervous.
Okay, so nerves are high. Let's just rip the Band-Aid off and look at what's actually driving the anxiety. We have to start with the history maker. Gold.
It is the single most significant number on the board today. Spot gold has officially broken $4,800 an ounce.
$4,800. I remember when we were shocked it hit $3,000. That feels like a lifetime ago.
It's a new historical high. But you have to look at the why here. This isn't just, people buying jewelry or some industrial demand kicking in.
Oh.
This is what the report calls a sell America trade. We're seeing a weakening U.S. dollar. The DXY index is slipping. And that's combining with some really intense geopolitical tension to just drive institutional money into hard assets.
When you say sell America, that sounds pretty aggressive.
It's a sentiment indicator, really. It just means that global capital is looking at the U.S. fiscal situation, the political landscape, the Fed, and it's deciding to hedge.
So they're not dumping everything.
No, not necessarily dumping all their U.S. assets, but they are buying insurance against the U.S. dollar system itself. And, gold is the ultimate hedge against a fiat currency losing trust.
And usually when gold goes parabolic like this, it pulls the other metals up with it.
Yeah.
So what's silver doing? Is it riding those coattails?
Silver is definitely drafting behind it, but it's a totally different beast. The report notes that silver is really more of a short to medium term trade right now.
There's a distinction.
It's because silver has a much higher beta. In finance, beta just measures volatility relative to the market. So silver moves faster than gold, basically.
So more risk, more reward.
In both ways. When gold goes up 1%, silver might jump 2% or 3%. But if gold sneezes, silver catches a real bad cold. The report specifically warns that, even though the gold-silver ratio is shifting, you have to be super cautious with leverage here.
Right.
This rally is a flight to quality, and that's gold. It isn't necessarily a flight to speculation, which is often what silver represents.
Okay, which brings us to the other side of that coin, or the digital coin, I guess, Bitcoin. If gold is at $4,800, the old narrative has always been that digital gold should be flying too. They're both supposed to be these hedges against the system.
Yeah.
But I'm looking at the dashboard and it is deep red.
It's a bloodbath, an absolute bloodbath. Bitcoin has retraced significantly from its highs. We're seeing it dump down into the $89,000 to $92,000 range.
That is a sharp drop. We were flirting with 100K not that long ago.
It is, but the price drop isn't actually the main story here. The mechanism of the drop is what really matters.
Okay, so what happened?
A liquidation cascade. CoinDesk is reporting a $1 billion flush in long liquidations.
$1 billion.
Yeah.
Vaporized.
In a matter of hours, yeah.
Okay, explain that for someone listening who maybe just holds some Bitcoin in a cold wallet. How does $1 billion just disappear like that?
So this is all about leverage. You had traders borrowing money to bet that Bitcoin would go up and break that massive resistance level. They were long with leverage.
Okay.
When the price dipped, even just a little bit, it triggered their stop losses. Their brokers automatically sold their positions to cover the loans.
And that selling pushes the price down even further.
Exactly, which then triggers more stop losses from the people below them. It's a domino effect. So the market shifts from FOMO, fear of missing out, to just aggressive deleveraging.
It flushes out all the gamblers.
It really does. So the narrative has totally shifted.
From buy everything to get me out.
In the crypto sector, yes. The report is noting that the critical resistance for Bitcoin is now sitting at that $95,000 to $98,000 level. That's the ceiling we have to break to get bullish again.
And until then?
Until then, the trend is strictly risk off.
And it's not just Bitcoin. The altcoins are getting hammered too. I'm just seeing red across the entire board.
Oh, they are. Ethereum is sort of oscillating between $3,100 and $3,300. Solana is seeing really high volatility, bouncing between $130, $140. BNB is sitting in that $880 to $920 range.
The report calls it high volatility.
And for good reason. The liquidity just isn't there to support those prices if a real panic sets in.
Speaking of liquidity issues, I saw a mention of pre-stocks in the report. We're talking about those private market contracts for companies like Anthropic and OpenAI, the ones that haven't IPO'd yet.
Right, the pre-IPO contracts. The report labels them, and I'm quoting here, high risk, small position only.
Why high risk? I mean, it feels like everyone wants a piece of Anthropic right now.
Everyone wants to buy. But the question is, can you sell? The issue is liquidity. You might see a price on a screen that says your Anthropic shares are way up, but trying to actually sell a large position in a pre-market contract, well, it's incredibly difficult right now.
So you're stuck in the doorway.
Precisely. The spread, the difference between what buyers are offering and what sellers want is massive. You might have to take a 20% haircut just to get your cash out. It's a real trap for the inexperienced investor who treats private equity like it's a stock market ticker. It just doesn't move that fast.
So let's just recap where we are. Gold is flying, which implies fear. Crypto is crashing, which implies a lack of liquidity.
Oh.
But yeah, I'm looking at the S&P 500. It's kind of fun. It's not crashing. Where's all the growth money hiding?
It's hiding behind a very, very specific shield: artificial intelligence.
Of course it is. It always comes back to AI, doesn't it?
It's that offense trade I mentioned at the start. The money leaving crypto isn't necessarily going to cash under a mattress. Some of it, at least, is rotating into what the market sees as high-quality tech. NVIDIA. Ticker NVDA, trading around $185 to $190. It's still the liquidity anchor for the entire market.
The anchor.
Yes. If NVIDIA holds, the broader market feels okay. The report explicitly says that NVDA and its supply chain are the fund's gathering core. Basically, if you are a fund manager and you need to show growth to your investors, you can't afford not to own it.
So it's become a defensive stock. In a weird way.
It's kind of wild, right? A high-growth tech stock as defense. It's all because of the cash flow. These companies are just printing money, and that feels a lot safer than Bitcoin, which produces nothing, or bonds, which are losing value against inflation.
What about Tesla? Usually it moves with the rest of the tech pack.
Tesla's just being Tesla. The volatility there is all driven by delivery news, regulatory headlines. It's less of a structural hold for these big funds and more of a news cycle trade at the moment. It doesn't have that same shield status that NVIDIA has.
So if I'm listening to this and I see gold skyrocketing, Bitcoin crashing, but stocks are basically flat, it just feels unstable. You know, like a table with uneven legs.
It is unstable. And that's exactly why the report advises that your defense space should be the broad ETFs.
VOOQQQM.
VOO for the S&P 500, QQQM for the NASDAQ 100.
Yeah.
Despite the high valuations, and they are high, these are really the only places with enough depth to absorb these huge capital flows right now. If $1 billion wants to enter the market, it goes to the S&P 500.
Okay, let's unpack the why. We've got the what gold up, crypto down, AI holding steady. But what is driving this huge macro split? The report mentions this sell America sentiment. That sounds ominous and honestly a bit political.
It's less about politics in like a partisan sense and more about geopolitical stability. The narrative that's bleeding into the financial plumbing is just uncertainty.
Uncertainty about what, specifically?
The Federal Reserve. The report alludes to these political and judicial controversies around the Fed. We don't need to get into the weeds of the court cases, but the market absolutely hates uncertainty, especially when it involves the central bank's independence.
Right, because if the Fed is paralyzed, then who's steering the ship?
Exactly. And the falling dollar, the DXY index, that's the canary in the coal mine here.
Why is the dollar falling? if the U.S. economy is supposedly strong? I mean, usually a strong economy means a strong currency.
That's the big disconnect. International investors are looking at the U.S. political landscape and they're saying, you know what, maybe I won't buy treasuries today, maybe I'll buy some gold instead. They're diversifying away from the U.S. system itself.
Which brings us to interest rates. The 10-year Treasury yield. This is the number that things like mortgages and credit cards are all based on.
And it is stuck. It's just grinding in this 4.15% to 4.23% range.
Is that high? Low? What does that mean?
For a market that's priced for perfection, it's stubbornly high. A 4.2% risk-free rate, it acts like gravity on stock valuations.
Okay.
I mean, think about it. If you can get 4.2% guaranteed from the government, why would you risk your money on some stock unless it's going to grow massively? It just makes everything more expensive to finance. If the 10-year was dropping to 3.5%, we'd see a huge rally in everything. But it's not budging.
And what's the Fed seeing? We have data from the Cleveland Fed, right?
We do. And the Cleveland Fed nowcast data suggests that core inflation is actually dropping, which, technically, is good. It should be a signal for the Fed to cut rates.
But there's always a but.
But the jobs number really complicates things. The December non-farm payroll showed a pretty significant slowdown. Only 50,000 jobs were added.
Only 50K. That sounds like a recession warning. We're used to seeing, 150K, 200K in the headlines?
It's a definite cooling. The report describes it as the labor market moving from super hot to just normal. It hasn't collapsed yet. We're not seeing massive layoffs. But the engine is definitely sputtering.
So the Fed is in a bind.
A massive bind. The inflation data says cut rates, the labor market says cut rates, but the geopolitical risk and the debt issues are keeping those yields high. So if they cut too fast, inflation might roar back. If they wait too long, the economy stalls.
I want to dig into something the report calls liquidity ping pong. It sounds like a game, but I have a feeling it's about the plumbing of the financial system. This is the stuff that usually bores people until it breaks.
It is the plumbing that keeps the lights on, and if this breaks, your ATM stops working. The report highlights two very specific acronyms, ON-NRRP and SRF.
Okay, hit us with the definitions.
ON-NRRP is the overnight reverse repo facility. SRF is the standing repo facility. You can think of these as the overflow tanks for the banking system's cash.
Overflow tanks, got it.
When banks have too much cash and nowhere safe to put it, they park it at the Fed in the ONRRP. When they desperately need cash and don't have it, they can borrow from the SRF.
And what are those numbers telling us right now?
At year-end, usage was massive. ONRRP was around $106 billion. SRF was about $74.6 billion.
So why does the average listener need to care about $100 billion in some repo facility?
Because it tells you that the system is thirsty for liquidity. When banks and funds are parking that much cash overnight or borrowing that much, it means they are terrified of running out of cash in the short term. It shows the market is highly, highly sensitive to any kind of liquidity shock.
So if something unexpected happens, a big bank failure, a war escalates, there isn't a lot of cushion in the system.
There's not. If the plumbing gets clogged, that's how you get a flash crash. It's why we watch these really obscure numbers. They tell us how fragile the system is just underneath all the stock prices.
So we have a fragile system under the surface. What about commodities? Usually when gold rallies on war fears, oil rallies too. Energy and gold are usually best friends in a crisis.
And that's the big anomaly today. That is by far the weirdest part of this report. WTI crude oil is sitting low, $59 to $60 a barrel. Brent is around $64.
That seems incredibly cheap, $60 oil.
It is. So while gold is pricing in war and currency collapse, oil is pricing in recession.
Explain that disconnect.
Gold is an emotional trade right now. It's fear. Oil is a purely economic trade, supply and demand. The oil market looks at that weak jobs report, that 50K number, and says, okay, factories are slowing down, people will drive less, shipping will drop. Plus, you've got rising inventory expectations. The market believes there's a glut of oil coming.
So you have gold screaming World War III, and oil is just whispering economic slowdown.
That is a terrifying divergence. It's total signal confusion. And when signals get confused like this, volatility, the VIX goes up. Investors just don't know which story to believe.
Okay, we've painted the picture. It's January 2026. Gold is at $4,800. Bitcoin is flishing. The plumbing is rattling. The listener's holding their phone, looking at their portfolio, and probably sweating a little bit. What do they do with all this?
The report gives us a very specific strategy checklist. It's really all about survival and opportunistic aggression.
All right, let's run it down. Point 1.
Defense first. The advice is to keep the bulk of your portfolio, the core, in broad ETFs. your VOO and QQQM. Don't try to be a hero and pick the one single winner in a market this volatile. You need the diversification of the index. If NVIDIA drops, the index hurts, but it's not going to zero.
Okay, point 2, the shiny stuff. Is it too late to buy gold at $4,800?
Gold hedge. So the report suggests it's not too late, but you have to change your mindset. You aren't buying it to get rich next week. You are buying it as a systemic hedge.
Fire insurance.
It's fire insurance for your portfolio. Some allocation to gold ETFs or even physical gold is recommended in case that Sell America trade really accelerates.
Point 3, AI.
AI accumulation. This is where you can play a little offense. The strategy is to buy the dip on the leaders. NVDA, Meta, GOOG, but, and this is so crucial, you have to do it in stages.
You mean dollar cost averaging?
Yes. DCA. Don't dump all your cash in at once. If NVIDIA drops from $185 to $175, you buy a little. If it goes down to $165, you buy a little more. You want to smooth out your entry price because this volatility could easily take it lower before it goes higher.
Makes sense. Point 4, crypto. For the people holding the bag right now.
Crypto caution. The trend is currently risk off. The advice here is strict stop losses. If you're holding, you need to know your exit point. And watch the ETF flows. If the institutions stop buying the Bitcoin ETFs, the price has no real support.
Don't just hope it comes back. Have a plan.
Exactly. And finally, cash.
Cash is king.
Cash is king. Keep cash or short-term bonds ready. If those political, judicial, Fed issues cause a sudden drop, or if that liquidity plumbing breaks, you want to be the person with dry powder ready to buy the wreckage.
It's a classic barbell strategy.
Yeah.
Extreme safety on one side with gold and cash, and high conviction tech on the other.
Yeah.
And just nothing in that messy middle.
Precisely. You want to avoid the mediocre assets right now.
Before we wrap up, I want to circle back to the intro. We talked about the big contradiction.
Yes. And this is the provocative thought I think we should leave everyone with.
Go for it.
If the Sell America trade is really pushing gold to $4,800, well, that implies a massive loss of faith in the US dollar and the US system. It's a very, very bearish view on America.
Right.
But at the exact same time, US tech stocks, your NVIDIAs, your Metas, your Googles, are holding near all-time highs.
One of them has to be wrong.
Exactly. They can't both be right in the long run. Either the gold market is in a massive bubble that's about to burst because the US economy is actually fine, or the stock market is completely, totally underestimating the risk to the US dollar.
And if the dollar collapses, those US stock valuations have to reset lower.
And if the US economy stabilizes and strengthens, gold should crash back down to $3,000.
So we're basically watching a high-stakes game of chicken between the gold bugs and the tech bros.
And right now, the gold bugs are winning on the scoreboard, but the tech bros still have all the liquidity. It's going to be a violent collision when one side finally swerves.
That is a scary thought to end on. But hey, that's why we do this. Keep your eyes on the PCE data coming up. Watch that 10-year yield. And for heaven's sake, check your stop losses.
And watch the VIX. If it crosses 25, the whole game changes again.
This has been The Deep Dive. We'll catch you tomorrow.
Stay safe out there.